Hey folks, my name is Mansoor Sohail. You may call me Manny for short. I'm an accountant operating out of Scarborough, Ontario, and my specializations are tax for Canada and USA. My today's presentation is for educational purposes only. I am going to talk about how to make projections out of the income statement. Making projections for income statement requires spending a lot of time, research and understand core of business model, understand revenue and cost structure, future performance. A good model is functional, flexible, and very easy to adjust. Revenue. Revenue is very difficult to predict. It is very important to understand a company's business model and gather as much information as possible to be able to make judgment of your own. Revenue is usually driven by a product of pricing and volume. So for projecting revenue, you should understand company's pricing and volume. You should be able to understand what initiative the company is taking to increase its volume. You should look into if the company is increasing its advertising. Is it acquiring other businesses or customers? What outside forces could affect the company's pricing model? Is it increasing its prices? Is it facing tremendous market competition and must lower its prices? Source for information. For source for information, you can look under investor presentations. Try to look for recent investor presentation on investor relations section of company's website. These presentations can have high level projections. Earning calls. At earning calls, you can listen to the management speaking about company's most recent financial performances. Management also sometimes gives guidance on the company's future performances. Wall Street research. If a Wall Street analyst has a research report on a company, it will have estimated future performances. Data source. Yahoo Finance, Thomson, First Call, and Bloomberg are few examples of data source. Cost of goods sold. For a best future estimate, it's very important to understand each cost. First, we need to consider if the costs are fixed or variable. A fixed cost is static and may grow a certain percentage. Rent expense can be considered as a fixed cost. It may increase 5 to 10% each year and is independent of growth in revenue. Variable costs, on the other hand, are directly proportional to growth of business. If revenue is expected to increase by 10%, variable costs will also increase by 10% and vice versa. Cost of goods sold is usually considered a variable cost. If your revenue is decreasing, most likely you are selling less products. Hence, your costs should also be decreasing and vice versa. If revenue increases due to increase in price, it means that the costs are not increasing because there is no increase in volume. If a supplier increases his prices, seller has to increase selling price also. In this case, revenue and costs will increase proportionately. This is why a company's business model and cost structure are very important to understand. Historical trends can also help us determine how to make best projections. These are few of the methods, like take an average percentage of the last 3 years. Take a maximum percentage of the last 3 years. It's called a conservative approach. Take a minimum percentage of the last 3 years. It's called aggressive approach. Take the last year's percentage. Have the percentage steadily increase or decrease year over year. Operating expenses. We can use same procedures for each cost on the income statement. Must conduct an adequate research, analyze historical trends, and consideration of each cost to be fixed or variable is very important. Taxes. We can take a look at historical taxes as a percentage of EBT, earnings before taxes, to make our projections. All this information I have gathered from Financial Modeling and Valuation, written by Paul Pegnataro. Thank you for listening.